Hello, everybody. Luke Groman, FFTT. Hope you're well and that everybody had a great weekend. Beautiful weather here yesterday, particularly for Cleveland, 82 degrees, which is pretty nice for this time of year. It's probably been the nicest spring we've had in maybe 20 years. So, at any rate, let me jump in for tonight. A few questions here. The first one is from Georgist here. Monetary policy is about who wins. It's a political decision. If this is true, why would the politicians go for inflation when the main losers would be those on a fixed income, like the baby boomers? Politically, this way out's a very bad choice. Why would they do this? To me, the answer is because nobody's a bigger debtor than the government. And I agree, it's all about politics. But let's take a look at the situation. The political authority, the U.S. government, sovereigns more broadly, are the biggest debtors. They have complete control of the printing press, and they have complete control of the inflation statistics. And so I suspect we're going to look back in 5, 10 years. History books will look back and say, how did anybody think post-COVID that the outcome was going to be deflation, given that the political authority desperately needs inflation, is the biggest debtor, has the printing press, and prints the inflation statistics? Next question is from SV. What would be the biggest or best investment theme for the next 10 years? To me, I think certainly for the next 5 years and maybe the next 10 years is that U.S. real rates are going to far more negative levels than virtually anybody thinks. Consensus, as far as I can tell, is still that U.S. real rates bottomed at negative 1.1% in August of last year. I think at a minimum they're going to negative 5 to 10%, and I think they could go lower than that. And the reason I think that is if you look back to the last time the U.S. was in close to as bad a fiscal shape as it was now, which was immediately after World War II, U.S. real rates went to negative 14%. And the U.S. was the winner of that war. We still had a lot of capacity. The losers, the people who had been deindustrialized by World War II, saw negative real rates of negative 20 to negative 60%. So it's interesting. You hear policymakers say we have to fight COVID like it's a war. It's a war. We need to spend like it's a war. Well, the last time as a war, real rates at the losers went to negative 20 to 60, and at the winners, they went to negative 14. So to me, the biggest investment theme by far is real rates didn't bottom, in all likelihood, in August of last year at negative 1. So let's see here. As such, the follow-on question that is inflation transient? At any given moment, it could be if the Fed doesn't do enough, if fiscal authorities don't do enough. However, if authorities want to delever their balance sheets, if they want to avoid a debt crisis, no, inflation is not transient. It is going to be much more persistent, and I think persistently undermeasured, but persistent. From WD, best guess on how long financial repression would have to run before real rates could be allowed to rise. In my opinion, the price target is not something that we're going to measure in time. I think it's something the price target for monetary policy is going to be in the aftermath of COVID. The U.S. is debt to GDP, excuse me, and so we're at 130% today. I think financial repression and significantly negative real rates will stay that way until we are at 80% debt to GDP, maybe 70, maybe 60, maybe 50. I think it's instructive to look back again to the last time the U.S. fiscal situation was nearly as bad as it is now, but really it's much worse now for a number of reasons. And that was in the immediate aftermath of World War II, and we saw debt to GDP in the U.S. go from 110% to 50 to 60% in 5 to 6 years, from 1946 to 1951. And again, during that time, we saw U.S. real rates of negative 14%, persistently negative real rates. And so I think ultimately this isn't about inflation. This isn't about employment, although it's more about employment than inflation. It's about delevering the government balance sheet and following whatever policies are needed to do that. From WMR, why is yield curve control necessary if the U.S. government's funding itself primarily with debt of less than 2 years in duration? Additionally, if longer-term rates are rising, maybe it gives off false signals of higher future growth as opposed to less buyers interested in longer-term treasuries. And I think, to me, it's really about managing a process because the longer-term, longer-dated treasury, particularly the 10-year, is a key policy rate for the real economy out there. And in particular, the housing market and everything tied to the housing markets and certain other real estate markets which are a huge part of effectively the collateral that backs the entire banking system of the United States. And so I do agree that longer term rates are rising in part due to this supply demand mismatch we have been highlighting for an extended period of time. And I think that will also factor into why the Fed will ultimately be forced into some form of yield curve control, I think, later this year. From DF, seems like you've swayed from being uber bullish gold to uber bullish Bitcoin. If so, what's led to this change in philosophy? I don't think it's a switch from one to the other. I think it's been just much more of a realization that the structure of Bitcoin, with its lack of an unallocated Bitcoin market like the unallocated gold market in London, the fact that there's no unallocated Bitcoin market means that Bitcoin can actually function. Bitcoin, to me, is just the last functioning smoke detector in a financial asset world where policymakers have largely broken many or most of the others. They've broken gold with the unregulated, unlimited expansion of paper gold derivatives centered in London. They've broken interest rates by the unlimited expansion of central bank balance sheets. You can tell. Those are the key. If you control those, the risk-free rate to the capital asset pricing model is U.S. Treasuries. If the Fed's balance sheet is going to grow to make sure rates are at certain levels, then all other asset prices are going to be influenced. The release valve will be their balance sheet, and by extension, you would expect the currency to impact, you'd expect gold to go up. But instead of gold going up, gold derivatives have gone up. Bitcoin doesn't have those derivatives, and so we're seeing Bitcoin doing what gold should be doing. Ultimately, I think gold is going to do that, but increasingly, I think gold is going to do that in a very short period of time, unfortunately. I had thought maybe they would let it go. It's not being let go. It's very range bound. And so I still really like both. Like I said, when will they let it go is, of course, a question. It could be tomorrow. I wouldn't be surprised. It could be 5 to 10 years. I wouldn't be surprised. And so I think it's important to just kind of own both. I mean, I am cognizant that if I'm a policymaker and gold's going nowhere as I'm inflating things away, I can credibly say, look, there's no inflation, gold's doing nothing. And as Bitcoin goes to 100,000, 200,000, 300,000, whatever it's going to do, I can sit there and say, oh, well, Bitcoin's a bubble. And, oh, I'm going to regulate Bitcoin next week. I'm going to regulate Bitcoin next month. I'm going to regulate Bitcoin and just try to sort of control it by jawboning, which is sort of what seems like what they're doing. So that's really it. It's not that I have changed my view on gold at all. It's just more this practical realization that Bitcoin's structure is allowing it to move. Gold's is not yet. Finally, outlook for gold for the rest of the year. I think it's positive. You've got real rates, I think, likely to turn back down. I think you've got more stimulus likely to come even beyond what's been announced already. And I think you have a call option with the Basel III regulations coming in early July, I believe, in the United States, and early January in London. And again, I'm always careful with this because I've seen this sort of this is it for the unallocated gold market dynamic. I've seen this a number of different times. So I see any types of announcements regarding that with a big grain of salt. With that said, to my non-legalese trained eyes, the Basel III net stable funding ratio regulations as it relates to the gold market do seem to be designed to force a leverage wind down of the unallocated gold market. And as we were just talking about, were that to happen, were there just regulations on the amount of leverage that could exist in the gold market, it'd be a very bullish thing for gold prices, because then the price of gold would be the release valve, the release valve for those pressures rather than the amount of paper gold derivatives expanding. So that's it for tonight. Appreciate everybody joining me. As always, if you're interested in finding out what we're up to, please check us out at fftt-llc.com. If you like these updates, you'd love tree rings. It is a great 10 most interesting things summary of what's going on and synopsis and kind of what we're thinking, updating. You can find out more information about that on our website. Otherwise, everybody have a great week. Stay safe out there, stay healthy, and look forward to talking with you soon. Take care, everyone.